Welcome back. It's good to see you again. On my previous video, we talked about two simple portfolio and asset allocation strategy. If you haven't seen that video, please go to the description below and take a look at it and then come back to this video. Now we're going to talk about the two main investment buckets that individual investor has at their disposal. And one of them is the tax advantage account and the ordinary account. An ordinary account is basically an account where we want to put all the investments that are already tax efficient. Normally, these are stocks and mutual funds that pay qualified dividends or that you will hold for more than a year, so they will qualify for long-term capital gain. Think of a tax advantage account like buckets that give you certain tax benefit, like earning pre-tax level, or your gains will not be taxed when you retire. However, it has a lot of restrictions, like most likely you will have to wait until you're 59 and a half in order for you to withdraw the money without any type of penalty. But it's very, very important that you understand that none of these tax advantage account will prevent you from paying taxes. The only thing that it's doing is, when will you pay the taxes? Will you pay the taxes at the beginning and all your gains are tax-free as long as you withdraw after 59 and a half, like in the case of Roth? Or will you defer your taxes and your gains will be compounded pre-tax, and then you will pay taxes when you withdraw that money after 59 and a half? If you're getting value from my video, please hit the like and subscribe below. It really helps the channel and it doesn't cost you anything. Thank you. So let's talk about your employer-based tax advantage account, like your 401k, your Roth 401k, your 403b, or your TSP. All these tax advantage accounts are provided by your employer. Also, your employee might give you the benefit of matching your investment up to a percentage. Most likely will be between 2 to 6, 7% in the majority of cases. The main characteristic of the 401k is that your investment and your earnings grow at a pre-tax basis. This is very useful because it will help you maximize the compound effect of your investments. Another important characteristic of the 401k is that you're not allowed to withdraw from it until 59 and a half. However, if you do, you will have to pay a stiff penalty. You most likely will have to pay 10%, and you will also have to pay the taxes for everything that you withdraw from that account. However, there are several ways that you can withdraw from your 401k without having to pay the penalty. One of them is medical expenses. If you have medical expenses that exceed 7.5% of your annual adjusted gross income, you can withdraw from your 401k without paying 10% penalty. Also, if you become permanently or totally disabled, you might also qualify to withdraw money from your 401k without having to pay the 10% penalty. Another way is, if you pass away, your heirs can withdraw that money from your 401k without having to pay the 10% penalty. There are many other exceptions that will allow you to withdraw money from your 401k without having to pay the 10% penalty, like military separation, birth or adoption, COVID-19, or any other special situation. However, we're not going to touch that in this video. But if you're in the situation which you will need to withdraw money from your 401k for any reason, I suggest you to go and talk to a CPA accountant, so he or she will give you the best advice of how to do it, when to do it, so you will have to pay the least amount of fees and penalties for your withdrawal. Another important characteristic of the 401k is that after you reach 73 years old, you have something called minimum required distribution. Basically is the government mandates that you have to withdraw a minimum amount of money from your account so it could be taxed. Another tax advantage account that is much newer than the standard 401k is the Roth 401k. And the main difference, or the main characteristic of the Roth 401k, is that your investment and your gains are after tax. Before 2024, your Roth 401k balance were also subject to required minimum distribution. However, after the Secure Act 2.0 allowed those assets to continue growing tax-free as long as you pass it along to your heirs, and they will be able to take the benefit of continue the growth of your assets. In this case, now will be their assets at a tax-free basis. And another important characteristic of both the standard 401k and the Roth 401k is that there is no income limit in which you can invest into this tax advantage account. So that's very important for high income earners that they can still invest and take benefit of these tax advantage accounts. The next tax advantage account is not very common, but it's worth mentioning. It's called the Thrift Saving Plan, or TSP. Think of them as a 401k, but for federal employees or for military members. And they're usually much better than 401k. The main reason why I think that they're much better is because they usually have a lower expense ratio than a standard or Roth 401k offered by your private employee. If your employer doesn't offer any type of 401k or Roth 401k or 403b, it's okay. You also have individual based tax advantage accounts. These individual tax advantage accounts are called IRA or Roth IRA. And these are accounts established or set up by the government to allow individuals to invest into a tax advantage account for their retirement and to take the same benefit or similar benefit that the 401k offers. The good thing about it is that you will be able to invest in pretty much anything you want. You have full autonomy into what investment you want to put within your IRA or your Roth IRA. However, the big limitation that it has is that it has an income limit. So if you're a high earner, you might not qualify to invest into a IRA or a Roth IRA. So let's talk real quick about standard IRA and Roth IRA. Think of a standard IRA very similar to a 401k. The main difference is that on your IRA, you have income limitations, and on your standard 401k, you do not have any income limitation. However, just like your 401k, your IRA contributions and growth are tax deferral, meaning that you will pay your taxes at the end when you withdraw your money. And just like a 401k, you will have to pay a penalty if you withdraw your money before you're 59 and a half. And you will also have required minimum distribution, just like in your 401k. And your Roth IRA is very similar to your Roth 401k, but again, it has income limitation, but everything else is pretty much the same. The only big difference is that on your Roth IRA, you're not required minimum distribution. So that's a big plus of a Roth IRA. Let me finish this video by giving you some recommendation. If your company matches you up to a percentage, let's say 6%, always do the match first. Once you have completed your match, then you maximize your Roth IRA. Once you have maximized your Roth IRA, you go back to your 401k and try to maximize your 401k. One final thought. I have touched into a lot of governmental regulation and tax law in this video. Please do remember that this information could change at any time and most likely will change in the future. So I want you to use this video as your starting point for you to do further research before you start investing into different tax advantage or ordinary accounts. This was a long video, but a very important one. For anyone who's looking and starting to plan their retirement strategy, this is something that everybody should take a look at. Do more research and let me know in the comment below what I have missed and what other areas you guys are investing on that it will benefit the community. Thank you for staying until the end, and I will see you next Sunday.